Table, sponsored by Global X ETFs.
Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Otter. Coming up, small stocks rallying as investors look to the Fed's next move. Franklin Templeton fixed income CIO Sunil Desai gives her take on sectors that will benefit. And later, big tech in turmoil, what the major sell-off in the sector means for investors. But we begin with our expert panel and three things investors ought to be thinking about right now. On the Barron's Roundtable, my colleagues Ben Levison, Megan Leonard, and Andrew Barry. So, Ben, I think one chart tells it all in terms of what just happened in the market. If you look at the S&P 500 compared with small stocks, they're going in opposite directions.
Yeah, I mean, this is a major rotation. And by rotation, it's not me spinning around in my chair. No, it is that people are selling some of their tech stocks and they're buying other stocks. And in this case, they're buying small caps. And so we've seen a rally in small caps like we really have never seen before relative to the S&P 500, going back to at least 1986. And it's really just because people are selling their big tech and they're buying the small.
And one of our colleagues pointed out that there's so much money in big tech. I think, Andrew, the S&P, the Apple and NVIDIA are the size of the entire Russell 2000.
Exactly. I think the Russell 2000 is only about $2 trillion, which is less than just one of those stocks.
Wow. So what is it about small caps that have finally caught investors' eyes?
Well, it's all about the Fed. When we got this inflation report earlier this month, it showed that inflation had come down to the point where the market has started to price in a 100% chance of a cut when in September. We're probably not going to get one in July next week, but we'll see. That really just got people thinking, I ignored this asset class long enough. I better put some money there. And these companies really benefit from lower rates because their interest rates that they get are higher. They don't have as much cash. They benefit from a stronger economy, which is hopefully one of the impacts of a rate cut. So they've really just taken off from here.
Quick pivot to crypto. There's the possibility of a big announcement by Donald Trump on Bitcoin this weekend. You seeing anything there?
Bitcoin I always see as kind of a trade off of the NASDAQ. It goes there. What I'm really more worried about is the Fed. And are they going to be able to signal that September is really a go? And we're also going to have payrolls after that, which even if the Fed does signal that September is a go, may throw a little wrench into the works.
The number's too good.
Yeah.
Megan, not only tech, but a really bad week for the automakers. Ford was down 20%, GM and Tesla down more than 10%. What's happening?
Yeah, it was pretty dismal this week. I think investors were a little bit trepidatious on, what they were seeing from earnings. So honestly, GM's earnings were actually decent. I mean, they had better than expected results. They actually raised their guidance. So arguably you thought, oh gosh, this was going to be good, but investors were not impressed. And so I think there was some concerns about their EVs. So we'll have to see how that goes. Now, Tesla did not do as well. Obviously, their earnings were a little bit lower than expected, but I think this all comes down to a little bit of razzle-dazzle from Elon Musk, and we just didn't get it. So I think, there's some concerns about their robo-taxi ambitions and everything else. We'll have to see how that goes as well.
Still waiting for the robo-taxi, but the really bad news was from Jim Farley. Ford had said it was getting control of its quality issues, but $800 million spike in warranty costs?
Yes, they had an absolute disaster of an earnings. And it was interesting because we really didn't get a lot of signals ahead of time that this was coming. So I really think it took investors a little bit by surprise. You saw that they're actually, as of yesterday, they were in bear market territory. So Thursday, it was a disaster for them. And I'm not sure that they're going to be able to recover quickly from this. This raises some long-term concerns.
A great American company, but ugly times. Andrew Barry, you have pulled off something that very few business journalists could do, which is this cover story in this week's Barron's about the financial engineering Rube Goldberg contraption that is John Malone's Liberty Media empire. Tell us about it.
Well, John Malone has been investing in media and cable for 50 years, and he controls or influences a surprisingly large number of companies. Some of them are thriving, like Formula One and the Atlanta Braves, and others are having some challenges like Charter Communications and SiriusXM, the satellite radio company. But there's some investment opportunities, I think, throughout the Malone empire. For starters, he's 83 now, and you could see sales of some of these companies in the coming years.
He's very tax conscious, I know, and that's controlled the way he's done things. Let's look at the bright spots. Formula One, suddenly hot in this country, and he's got a way to play it.
Well, he controls Formula One, which is the international racing business, which is increasingly popular here in the U.S., in part due to the success of Netflix's Drive to Survive. Stock's around 75 now, could be worth around $100 a share. And so there could be some nice upside there.
In Vegas, they repaved the streets to make way for that race, right?
Exactly. It was the first race in Vegas and really got a lot of attention.
Okay, so on Thursday night in the 10th inning, a dinger by Jeff McNeil for the Mets beat the Braves. But that said, the Braves are a pretty good franchise, and you can invest in them.
Yeah, they've consistently been one of the best teams in Major League Baseball, and they're also very well run from a financial perspective. What's interesting is that Malone may be willing to sell the team in the coming year, and he could get $3 billion plus for the Braves, which would translate into a stock price of around the mid to high 50s versus the current share price of around 43.
His timing is really good here. Sports is one of the hot investments. Every billionaire wants a team, right?
Exactly.
All righty, thanks, guys. Cooling inflation data this week convinced investors that rate cuts are coming. Franklin Templeton fixed income CIO Sonal Desai tells me the Fed may not deliver everything the market is hoping for. Next. Markets rebounding Friday on strong earnings and GDP growth and slowing inflation with PCE numbers in line with expectations. The Fed's favorite inflation gauge up 2.5% in June from a year earlier, the slowest annual increase in more than 3 years, but remaining above that 2% target. So does this calmer inflation reading mean the Fed can cut rates again? Here to discuss is Franklin Templeton fixed income CIO Sonal Desai. Sonal, thanks for joining us all the way from Milan.
Jack, it's so nice to be here.
So
thank you.
What does this week's economic data tell you about when the Fed can start cutting rates, and how low do you think they'll go?
So I think the main thing here is the data. Yes, the market has finally largely absorbed, at least the bond markets, that the Fed is likely to cut, but is not going to go overboard. We are looking at, I believe, 2 cuts this year, probably starting in September. And more importantly, I'm not anticipating more than 125 basis points of cuts in this cycle. So I don't expect rates to go as low, perhaps, as the market is currently anticipating, to around 4%, market saying 3.75. But yeah, I think bond markets have been good about this. They haven't been overshooting.
I think part of the reason you're saying that is because you have expressed concern that at the long end of the yield curve especially will be affected by deficits, which you say are probably going to continue to go higher, whoever wins in November.
Pretty much. I think the expectation or anticipation of extreme fiscal conservatism from either party is vastly overdone. Here's the thing. We've had a Democratic administration, as we know, for the last 3 or 4 years, and we've had massive fiscal deficits. If I look at what the plans are from the Republicans, that's not going to result in smaller deficits. So whether you go with a Democratic administration or a Republican administration, I think fiscal conservatism is simply not in fashion right now.
And what's particularly interesting about this, and we're going to get wonky for no more than 60 seconds, this is what's called pro-cyclical stimulus, which historically is unusual. Economics 101 says you can cut taxes, you can increase spending in bad times, but when times are good, you're not supposed to do that, right?
That's absolutely correct. Because here's the thing. We've been growing so much beyond potential, and we're running a fiscal deficit this year of close to 7% of GDP. We've been at 6% plus the last several years. And before anyone starts talking about tax cuts, it's not just the tax cuts. We've had a massive spending boom in the post-COVID period, and it doesn't seem to be going away. And the reason economists don't like that is typically when the economy is doing badly, you want the government to be able to increase its deficit, and the deficit will go up because unemployment payments go up during times of economic slowdown. It's not supposed to happen when the economy is simply doing fine by itself.
Oh, okay. I do want to get to 2 stock picks, or 2 investment ideas, I should say. The first one is equity related. At the beginning of the year, you told Barron's you were keen on a value fund that invests in value stocks, obviously. And in the last few weeks, it seemed like that was a smart move.
Well, I think that what's really happened over there, I'm not an equity person, as you know, Jack, but what has happened is over the last 18 months, we have seen that the top 10 stocks in market cap weighted terms have gone from being 25% of the S&P to 37%. I think essentially things got so stretched that we got a snapback. We didn't expect to see the snapback as rapidly, perhaps, as we saw, but it is completely in line with the theme of an expansion, a broadening of the S&P's performance to other parts of the structure, including small and mid, and broadening out, basically. This is a theme which I think we need to play. It's not that AI isn't important, but perhaps it's a good idea to play AI via, for example, energy and other areas which get impacted by AI. I'm not downplaying AI.
Reversion to
I
the
think
mean.
there are better ways to.
Reversion to the mean is a powerful force. Real quick,
It is.
in a few seconds, can you tell us about this ETF that owns floating rate securities, and it's got a nice yield?
Yes, the yield is close to 9%, and essentially what we're looking at with the floating rate fund here is a very actively managed bank loan fund. We don't expect interest rates to come dramatically lower. However, any cuts in interest rates are going to impact and positively impact some of these borrowers. I think this is a good place to get your income, and if in my environment, in my outlook, I'm not anticipating a massive collapse of the economy, I think this would be a good place to get some yield.
Sonal Desai, thank you for the economics lesson and the investment ideas. We appreciate it as always.
Thank you, Jack.
Big tech taking a tumble this week. We'll discuss how investors should play the industry's stock sell-off next. The Nasdaq getting crushed this week as a big tech sell-off drags on the index. Are the Magnificent Seven done? Barron's senior writer Paul LaMonica joins the panel to discuss. So, Paul, it was the trade for, a decade or more, big tech, but a second bad week in a row. The Q's down about 4% despite the Friday rally. What's going on?
Yeah, the earnings from Alphabet and Tesla really disappointed investors, not necessarily because they were that bad. I mean, Alphabet, had healthy results, but the expectations were just so high coming into this earnings season. And keep in mind, Tesla's a stock that was really beat up in the first quarter of this year. It's had this stunning rebound. So all of a sudden, again, there were a lot of high expectations for Tesla. They missed earnings estimates, so that sent that stock down pretty sharply after the results came out.
And this AI thing is sort of cutting both ways, because yes, Google might be a beneficiary, but at the same time, massive spending on just getting geared up for AI. And so some companies are doing well, some companies are maybe, I think investors are worried if the ROI is going to be there.
Yeah, definitely. I mean, when you look at Alphabet, the fact that they're spending so aggressively, $12 to $13 billion a quarter, so that's nearly $50 billion for a full year. It's a lot of money, and the payoff is not yet certain in the same way that it is for NVIDIA and some of the other chip companies that have rallied pretty sharply because of their AI results.
So you mentioned that the Alphabet results were not quite so terrible. What were you optimistic about within the basket, if you will?
Yeah, I think that overall Alphabet remains the dominant player in search, so advertising revenue should hold up well for them. And the AI investments, it's not the case that we don't know if they're going to pan out over the long haul. It's just that they're spending so much money, and I think we're now at a time where investors are worried about companies and possible profligate spending.
Sounds like maybe investors need to be a little bit patient.
Yes, they do, definitely. I mean, these are going to take a couple of years for these investments to probably pan out. It's not going to be this immediate payoff.
Yeah, and with NVIDIA, you've seen, which has been the prime AI play, the stock has pulled back about 20% from its recent high after a huge run earlier this year. Then the valuation's still not cheap at around 40 times earnings. I mean, what are you thinking about that?
Yeah, NVIDIA still looks pretty interesting because they have pricing power. They are the clear dominant leader in AI chips. Intel is woefully behind. AMD is trying to catch up. And not to sound sound Pollyannish because I've been around to remember the tech bubble. NVIDIA at 40 times earnings is by no means cheap. It's double almost the market multiple, but it's not Cisco at a triple-digit PE from the late 90s, early 2000. NVIDIA has corrected already. It's possible when we get their earnings. Remember, earnings in late May sent the entire tech sector on a amazing rally again. Remains to be seen whether or not that can happen in late August as well.
Yeah, one of the things I find interesting is that there's this rotation going on. It's not just out of tech, but it also seems to be within tech, where we're seeing software stocks like the IGV ETF, which is a software ETF, that is actually holding up pretty well, even as tech gets hit. And then you have something like ServiceNow, which popped on its earnings because AI seems to actually be helping.
Yeah, very strong performance from ServiceNow. AI clearly benefiting that company's results. It's similar to what we saw with Adobe and Oracle earlier on. Their results also fueled by AI, and those stocks have done well. But it's really a pick or choose type of market right now. Salesforce had a bit of a stumble after they reported their latest quarterly earnings. AI taking a little bit longer to pan out for them.
All right, next week we've got Meta, Apple, Amazon, and Microsoft, the mama trade, if you will. What are you expecting?
Yes, for the Magnificent Seven, we're going to be looking very closely to see what Meta's AI investments look like. Will there be a hangover similar to what happened with Alphabet? I mean, we all know Mark Zuckerberg has not been afraid of spending on big themes, even if they take a while to pan out. We're still waiting for the metaverse to pan out. Maybe they rename
Not
themselves
sure that ever will.
AI platforms. Who knows? But then with the case of Microsoft and Amazon, I think their cloud business, we're going to wait and see if there's momentum there with Microsoft's huge cloud business and AWS on the Amazon side. And then Apple, again, also an AI play. The AI-enabled iPhones are still a ways off, but Apple needs to catch up in artificial intelligence to prove to Wall Street that it can be a player in this as well.
The hope is it'll be a whole new super cycle of people buying those phones with the new AI capability. But remember, guys, the Magnificent Seven, only 3 of the good guys rode away alive. So we'll see who survives the Yul Brynner, Steve McQueen, one more. Andrew. Who is the no?
It's been a while since I've seen it.
Thanks, guys. Ben and Andrew have a pair of investment ideas, and Megan is taking a peek into Kamala Harris's portfolio. Stay right there. Megan, boring is not a word most people associate with this presidential race, but when Kamala Harris released her financial disclosure, it was pretty boring. Plain vanilla index funds, in retirement accounts, kind of like the rest of us.
It is. It was actually pretty similar to the average American, if, of course, the average American was investing as much in their retirement as Kamala and her husband do. So it was a good report. I mean, look, they make about $500,000 a year, so they do have some to put away. All said and done, they range somewhere in the range of 3.6 to about a little over 6 in terms of their total investment portfolio. I'm using ranges, of course, because the disclosure forms do not give us specifics. But, they have things like Vanguard, they have iShares in there, and of course, they even have a target date fund. So Kamala even has a pension. So about only 19% of Americans still participate in pensions, and she's one of them. She's very lucky.
Interestingly, one of the other ones is Donald Trump. He has a pension from the Actors Union, from Home Alone and some other stuff. So he's already getting checks from that. But one more thing in the disclosure that's interesting was that mortgage rate.
She has a great mortgage rate. She and her husband have a great mortgage rate. So they have a home in LA, and they were able to get a 2.6 mortgage on it in 2020. So it'll be an interesting see how that shakes out in the future.
Could be a while before we get a 2 handle. In fact, it'll be bad news if we get a 2
do.
handle. All right, let's go to actionable ideas. Ben, what do you have for us?
I'm looking at a company called The Trade Desk. They do online advertising. Dropped 4% this week because people were worried about YouTube, which didn't have some great results when Alphabet reported. But it really looks overblown. Some analysts are saying that it could really bounce back from this when it reports earnings on August 8th. It looks pretty interesting here.
And Andrew, you're tapping the Malone empire for your idea.
Yeah, I'm talking about Liberty Sirius XM. It's the tracking stock for Sirius XM, the satellite radio company. The appeal is that Liberty Sirius trades at about a 25% discount to the value of its Sirius XM stake, and that gap should close in September when the two companies merge. And you got a good company in the trade because Berkshire Hathaway owns about 30% of the company.
I got a follow-up for you, though. Yeah. Warren Buffett, we know, likes Sirius Radio. Yeah. Seriously Sinatra is his station. But my son the other day, he's 17, and he said, I don't even know how to use the radio in my car. For him, it's all on the phone, Spotify or whatever. Are you worried that over the long term, Sirius just isn't going to be the thing?
That's the challenge, and they've acknowledged that they have to try to get a younger audience because most of the audience is probably 50 plus. I mean, Buffett's 93 and he loves the Sinatra station. So, but the valuation's relatively low, and maybe they'll have some success with that in Pandora.
All righty. Thank you, Andrew. Thanks, Ben and Megan. To read more, check out this week's edition at barrons.com. Make sure you read Andrew's story. Don't forget to follow us on X, that's at Barrons Online, and on Facebook and Instagram for the latest show updates. That's all for us. We'll see you next week on Barron's Roundtable.